Good afternoon. This is Ken Long from Tortoise Capital with a review of the weekend and daily trading plan reports for February 4th, 2012. Starting with the weekend report, we have a market that is in bullish, quiet conditions. On an annual basis, using weekly RSI, we're at 62 out of 100, so getting towards the high end of neutral. On a 10-day basis, using the 10-day NDX, we're at 98 out of 100, or in overbought conditions. Percent stretch relative to the 200-day moving average is 7.79%. That is strong bullish, indicated by the green indicator there. 5-day slope of the 50-day moving average is at 0.99%. That's also coded a strong green, so very bullish. ADX over the last 14 days is at 28.6. That's a very strong bullish trend. And ATR percentage over the last 100 days is 1.07%. That's quiet. That's as strong a bull market reading as you can get. It's very strong on every indicator, and then it's not oversold yet on an annual basis. We're getting very close to declaring this a strong bull. Blended monthly rebalancing for February, the 26 ETF portfolio. Current holdings are small caps, U.S. real estate, and financials. The 13 ETF portfolio is small caps, U.S. real estate, and mid caps. That's a shift in strength away from large cap U.S. dividend payers, which were the winners while the world was worried. It's now shifting to the risk on trade, which is small caps and mid caps. Still, strength is in the U.S., but it's shifting towards risk on. Next reevaluation will be on or about 1 March. The ETF2 system, theoretical exposure remains at 100%. The model portfolio is at 100%. No new buys or sells this week, just adjusting some initial trailing stops or capital preservation stops. Just a quick review now of the 13 and 26 ETF portfolio. You can see the strength is still in the U.S. The Europeans and globals are all lagging. Treasuries, significant to note, is the only member of the 13 that's in cash. It has fallen below its 4-month moving average, and you can see that it's weakening on strength. It's still high on consistency and quality, but the first thing that turns is the strength rating, and Treasuries have now begun to confirm that it's risk on trade in the equities. In the 26 ETF, it's the same story being told. You can see financials have moved to the 3rd position. Brazil and Latin America continue their stealth move upward, doing even better than U.S. technology and diamonds. So that is a shift, once again, to the risk on trade. The emerging markets that are starting to work are Latin America and specifically Brazil. At the bottom of the list down here, agriculture, gold, and blended commodities. I'm still looking for those to make their turn. If the industrials continue to have strength, then the basic materials that support them should start to do well. And so that'll be a trend to watch for going forward. Next up is the market health check. Vertical blue lines represent 10, 20, and 30 days of look-back period. The solid purple line at the top is the swing high from last year at 137. We're getting very close to that, $3 more, and we'll be able to test that swing high. That's going to be a very important resistance level. If it can get through 137, close higher, then it's all systems go for the bull. For this really to be a no-kidding bull market, it has to get through 137 and hold. You can see the solid red lines represent previous support levels that have held. And then right now we have price is right along the solid black line in the middle. That is the 30-day regression line. The outer black lines represent the regression channel formed by the maximum excursion from that regression line that happened back on 19 December. And so the market has been uniformly up since then. We have price fair value at the regression line is how we interpret that. Price is better than the 10-day moving average, which is the green line, which is better than the 50, which is the thin red line. better than the 200, which is the boundary of the blue shaded area. So this is a bull. And we have ADX measuring strength of trend at 28.5. It doesn't become overextended until it gets up above 30. So we're right in the middle of this emerging bull then. Williams percent R is back into overbought conditions. It can stay there a long period of time. Percent price oscillator closed its jaws after a nice run up last week. However, the pullback was only to the 10-period moving average, found support, and then continued to march northward again, and that's very bullish. And so that's rated as green, and there's still room for it to grow past 137 if this is a normal bull. The slope, the bottom indicator here is the slope of the 30-day regression line. You can see that it rolled over slightly last week, but is now flattened out and getting ready to get stronger. So all systems point to green. On the upside then, 137 is the next critical test. If it fails 137, a pullback to 130, in other words, $5 pullback, would be absolutely normal and nothing exceptional. The first time that we would really challenge the health of this bull would be if it fell back to the 50 and the 200 down around 125. So we're looking at a normal move up would be $3. Safe side would be stop at 130. So we're fairly valued, but all systems go in green. So a very healthy market from the last 20 days. Taking a look at a summary of the ETF2 regional report, all 10 of the regions are on buy signals relative to their moving average filter. The U.S. at 65 is better than the EFA, the rest of the world at 56, so it's still strength to the U.S. in this bull quiet mode. Among the U.S. indexes, it is technologies and small caps are better than SPY. The mid caps are starting to catch up now, so next week I would expect to see them bypass SPY. The two strongest sectors are the NASDAQ 100 technology and U.S. small caps. The two weakest sectors are Japan and the Euro-Asia blend. Looking at the world market model, you can see all of the U.S. in the center is above average, so it's in the white with the exception of the smalls, where they are in the green, meaning they are exceptionally strong. So it's the U.S. dominating. You can see commodities, gold and silver, are lagging, as are international telecom, and that leaves Europe below average, mostly in the yellow with the exception of Sweden. Asian countries mix between below and above average. The strength leaders in Asia less Japan, Australia, and Malaysia, they've been strength leaders this whole past year. I'd expect them to keep going. You can see Mexico and Brazil and Latin America are now above average compared to the database. Canada and emerging markets are lagging. Weakness in Europe across the board. Among the business sectors in the U.S. and globally, strength is in industrials, technology, finance, and materials. So that is the risk on trade and a return to health in the manufacturing sector. The defensive sectors that led the way most of the way last year, healthcare, utilities, and staples, are now starting to lag. So that's, again, a shift to the risk on trade. Top 30 ETFs in the ETF2 database, being dominated by biotech, biotech again, small cap value, semiconductors, retailers, oil services and energy, U.S. small cap index, U.S. real estate, and those are starting to displace the bond funds and the dividend payers, which are starting to move down the list. So again, it's the risk on trade. Among the Dow 30, using the same kind of strategy, but now we're going to sort by strength, the strength rating. Strength: Home Depot, Caterpillar, Boeing, GE, Intel, and Cisco. Weakness in Alcoa, Coke, Procter & Gamble, and Hewlett-Packard, for those of you looking for extremes. Alcoa remains a favored trading target of mine. ETF liquidity, just a quick reference on average daily dollar volume of the last 30 days. And you can see the VIX down here has gotten very quiet at only 4.85% daily ATR percentage. These are the ones that are a combination of liquid and volatile, so good intraday trading targets as well as swing trades. You see Brazil at EWZ, excuse me. Pardon me, let me get that. Yeah. Brazil has moved up to the number 9 position, so money's starting to flow into Brazil and is bypassing treasuries in the diamond. So that's a stealth emerging market trade. That's been the case for about the last 4 weeks now. So continue to pay attention there. We'll shift now to the daily report. So I'm not going to cover the top bar since we got that during the strategy report. Looking at the gap statistics, 14 times out of the last 30 days the market has gapped down. 13 of those 14 times the gap down reversed to close higher than the open. That is the perfect scenario for the morning hook, and that's been working just fine. So waiting to see that pattern continue. Gap downs, I'm waiting to see local intraday support and then start playing a reversion to the mean and an upward move. On average, those 13 days gained 0.53% higher than the open, and the one day when it gapped down and dropped, it turned in an additional loss of 0.41%. The gap ups happened 16 times out of the last 30 days, almost evenly split between continuing to go. When it did, it averaged an additional 0.34%. 9 times out of 16, the gap up reversed and turned in a loss of 0.47%. So the gap up is materially different than what it's been doing on a gap down. So I'm looking for gap downs as a way to get long intraday. There are no signals in the overreaction or channeling systems. The daily pivots, you can see the reference data. Very narrow range on the pivots. The pivot is at 134.31 for SPY, and R3 is only $1.20 higher at 135.70, and S3 $1.10 lower at 133.15. So that's a measure of just how narrow the range was on Friday. You can see volatility has been declining consistently over the last 6 months. That has been favorable for the market that has now come out into the bull. You can see volatility has stabilized around this 1% a day. 10-day max pain among the Dow 30, Procter & Gamble, ExxonMobil, Verizon, Chevron, and Pfizer. So that's an oversold condition in the energy sector. So that means that it's due for a rebound. I'll be watching XLE as a measure of the energy sector, and then looking for individual companies to make a rebound and lead the way up. Among the ETF 100, it's the VIX, natural gas, oil, USO, and treasuries, or 10-day max pain. The only pattern signal we have is in Merck as a triple screen, and we have a handful of signals that auto frame out at better than 2 to 1. VIX, treasuries, ExxonMobil, Chevron, Verizon, and Procter & Gamble. So I'm automatically interested in the energy sector with ExxonMobil and Chevron coming in with nice auto frame technique. Market ADX almost at 30. You can see it's been a straight strengthening bull since about 30 days ago when it started, when ADX was below 10, and has consistently gotten stronger, and the bulls have been in charge. So that just confirms what we already know, that we're in a emerging young bull. The Dow 30 tactical summary. We have a handful of dojis have formed. The one signal on triple screen for Merck, you can see in the middle. The max pain range compression top 5: ExxonMobil, AT&T, Procter & Gamble, Chevron, and Verizon. The last 3 test out at better than 2 to 1 on the auto framer reward to risk. So Procter & Gamble, Chevron, and Verizon, all better than 2 to 1. I especially like Procter & Gamble because it was a percent loser on Friday. That leaves it at a oversold in terms of trade position. You can see relative to the other members of the Dow, it is dramatically oversold over the last 1, 3, 5, and 10 days, in the 1 month and the 3 months. So that's a sort of a perfect opportunity for it to start rebounding. On the positive side, you can see Alcoa, Caterpillar, and Bank of America have been outperforming over those same time frames compared to their peers. So I'll be looking at Alcoa as a trading favorite of mine to continue its strength. At 10.76, it's well above that key support level at 10. 11 is well within its range, and with a 10-cent initial stop, Alcoa is a potential momentum play for next week. Shifting over to the ETF 30, I can see a handful of dojis, no pattern signals. The max pain range compression candidates I've already highlighted. I'll point out that treasuries are at 4-to-1 in terms of reward to risk compared to a retest of their 10-day high. It would take a dramatic sell-off in the equities to make money flow back over to the treasury. So I would be cautious on just buying that one. The VIX is at 5.6 reward to risk. Again, a one-day sudden price shock would not be out of the unexpected here. And it has almost 5% intraday ATR percentage. So if there was a one-day shock, I'd be looking to target the VIX rather than TLT for the one-day play. Financials were a big winner on Friday, closing strong and turning in a 2.7% gain that dominated compared to the rest of the ETF 30. Looking at the frog statistics here, there's still a dozen candidates that have better than 3-to-1 on their frog quality number. Disney leads the way at 4.1, and with a standard deviation only 15 cents. That's not a bad play. I like CVX here. The Chevron has a 3.2% or 3.2 frog quality number, and with a standard deviation only 50 cents. And the fact that it's in max pain range compression, that looks like a interesting play inside the energy sector. Looking at the signal to noise ratio, the VIX, silver, natural gas, Latin America, ILF. That's going to be an interesting one. That has been a stealthy, upward trending stock. It's clearly leading the way for the emerging markets. The fact that it has a high signal to noise ratio says that it is very directional during the day compared to the spiders. So that would be on my short list. ILF, and then by extension EWZ Brazil. Silver continues to be of interest to me. An 80-cent standard deviation, and then a strong directional day at 0.54. So strong signal to noise. The fail stat for reference just measures the distance from the open to what becomes the low of the day. So when I'm looking for on gap down days or for things to sell off, one fail stat, find support, and then begin to reverse, and then I'm all over that as a strategy during the day. So I'll be looking at Alcoa tends to fail 20 cents before it reverses. So perfect day on Monday for me would be gap down in the market, Alcoa sells off 20 cents, Alcoa and the market start to go up, and then Alcoa has stronger relative strength in the SPY, and then I will pile on Alcoa if that scenario comes to pass. Taking a look at additional market mosaic indicators, the R-squared for the 30-day regression line in SPY is at 0.93. The slope is very steep. It's more than one standard deviation above normal for the last 180 days. That is a very powerful, no-kidding bull move. You can see the percent stretch relative to the 200-day moving average. It's come out of the pits, is now a full standard deviation above average. This is all consistent with a strong bull move. And so while we're prepared for pullbacks we'd be looking at as opportunities to add positions as soon as it starts to reverse. We'll be mindful of the fact that 137 is the 12-month swing high. So that wouldn't surprise us to see a $3 move up and hesitate. If we see hesitation, that's a good time to lock in profits. But we're at the upper end of a channel right now in a young bull, and so we'll be mindful of the opportunity to get long and stay long. That's everything I want to cover on the daily, and so that concludes the weekend report for February 4th. Again, to summarize, the story right now is strong bull approaching a key resistance point. It's the first time it'll have knocked on that door in months. All signs point to go. Risk on trade in the U.S. with smalls and mids and technology beginning to get better than the large caps. The U.S. is still better than the rest of the world. In the emerging markets, it's Latin America. Among the sectors, it's finance is leading the way. Energy is postured to make a rebound. And it's industrials and materials looking good right now. So plenty of targets for Monday. And keep your powder dry and your risk measured.